One of my clients is about to save $88,000 over the next 3 years. Not from investing, not from cutting expenses, from understanding one number on their tax return that controls their health insurance cost. Most people retiring before 65 have no idea this number even exists. I'm going to show you exactly what this number is, how it works, and how understanding it could save you 6 figures before Medicare kicks in. Here's what I'm going to show you. First, the exact IRS metric that determines whether you'll pay full price for health insurance or qualify for massive subsidies, and why it almost has nothing to do with your net worth or actual spending. Second, a real-world example of a couple spending $135,000 a year while showing the IRS only $43,000 of income and paying $0 for health insurance. Completely legal. And third, the 3 mistakes that destroy this strategy and why ignoring them could cost you over $150,000 before Medicare kicks in. Let's get into it. Healthcare costs are the #1 reason people delay retirement, and I get it. The fear is real. You've been told that insurance before Medicare is complicated. Metal tiers, benchmark plans, subsidy calculations, federal poverty levels. It's designed to make your eyes glaze over, so you just accept whatever you're quoted. But here's what most people miss. There's one specific number buried in the tax code that controls everything. And once you understand how to manage that number, healthcare transforms from an impossible barrier into a completely manageable line item. The problem is that fear of healthcare costs is doing one of 2 things to you right now. Either you're staying in a job you're ready to leave for another 5 or 6 years just to get to Medicare, or you're planning to retire and budget $2,000 plus per month for health insurance because you think that's just the reality. Both scenarios are costing you one in time, one in money. But it doesn't have to be that way. By the way, I'm Kurt Soupy, CPA and retirement planner for over 25 years. All right, here it is. The number that changes everything. MAGI. MAGI. Modified Adjusted Gross Income. Your health insurance premiums under the Affordable Care Act are not based on your portfolio size, your monthly spending, your home equity, or how much cash you have sitting in your checking account. They're based entirely on your modified adjusted gross income, essentially the number that appears on your tax return. Now here's the insight that unlocks everything, so pay attention. The IRS doesn't count every dollar you spend as income. Let me repeat that because this is where most people's brains break. You can spend $135,000 a year and only report $43,000 to the IRS as income. How? Because not all money you access counts towards MAGI. Let's break down what does count. Traditional IRA or 401k withdrawals, pension income, taxable interest and dividends, capital gains when you sell investments, part-time worker consulting income, and taxable Social Security benefits. They even add back tax-exempt interest from things like municipal bonds. Now here's what does not count towards MAGI. Roth IRA withdrawals, this is a big one. Money you pull from savings account or checking, spending principal from your brokerage account, money you already paid taxes on years ago, proceeds from selling your home, up to the capital gains exclusion, gifts and inheritance. This is critical. You're not hiding money, you're not evading taxes, you're not exploiting a loophole. You're simply understanding which buckets of money the IRS counts for subsidy purposes and which buckets they don't. Now let me show you exactly how this works with a real scenario. Meet Jim and Susan. They're both 62, living in Phoenix, Arizona. They want to spend $135,000 a year in retirement. Not extravagant, but comfortable. Travel a few times a year, help the grandkids, maintain their home, live their life. If Jim and Susan didn't understand MAGI, here's what they'd probably do. Withdraw $135,000 from their traditional 401k, report that entire amount as income, and then get hammered with full price health insurance. How much would that cost? For a benchmark silver plan in Phoenix for a 62-year-old couple in 2026, the unsubsidized premiums run about $2,450 a month. That's $29,400 per year. Over 3 years until Medicare kicks in at 65, that's nearly $88,000 in premiums alone. Now watch what happens when they understand the game. Instead of pulling everything from their 401ks, here's what they do. They withdraw $25,000 from their 401k. Now that counts. They pull $35,000 from their Roth IRA, which does not count. They spend down $55,000 from their savings and brokerage principal, does not count as MAGI. They realized $18,000 in long-term gains by strategically selling some appreciated investment. That counts. Now let's do the math. $135,000 in total spending, but only $43,000 reported to the IRS as modified adjusted gross income. For a married couple, $43,000 of modified adjusted gross income puts them at roughly 200% of the federal poverty level. At this income bracket, they qualify for a premium tax credit of about $2,150 per month. Here's where it gets interesting. Let's look at their actual premium cost. Bronze plan, gross premium of $1,875 a month. Apply the $2,150 subsidy, their cost is $0 per month. Silver plan, gross premium of $2,450 a month. Apply the subsidy, their cost is $300 per month or $3,600 per year. The gold plan, gross premiums of $2,890 a month. Apply the subsidy, their cost is $740 per month or $8,880 per year. So this couple spending $135,000 a year can choose between completely free bronze coverage, silver coverage for about half the cost of the cell phone bill, or gold coverage for less than $10,000 annually. Compare that to the $29,400 they would have paid without understanding modified adjusted gross income. Over 3 years, we're talking about saving between $75,000 and $88,000 depending on which plan they choose. That's not a rounding error, that's a nice RV. That's a fully funded emergency fund. Now, some of you are thinking this sounds too good to be true. Is this even legal? Yes, absolutely yes. This isn't even a loophole. It's not even a creative interpretation of the tax law. This is literally how the Affordable Care Act subsidy system was designed to work. Congress created these subsidies specifically to help people afford health care. The law explicitly says that Roth IRA withdrawals don't count, that spending your own savings doesn't count. That's by design. You're not gaming the system, you're using it exactly as intended. Others are thinking, but I already pay taxes on that money in my savings account. I shouldn't have to pay again. Correct. And you won't. That's exactly the point. When you spend money you've already paid taxes on, the IRS doesn't count it again. That's fair. That's how it should work. And finally, doesn't this hurt other people or burden taxpayers? The subsidies are part of the ACA framework. If you qualify based on your income, you're entitled to them. That's how the law was designed. Not using subsidies you're eligible for doesn't help anyone else. It just means you're paying more than the system intended, while the insurance company receives the same premiums either way. But here's where this gets dangerous and why I said most people completely destroy the strategy. There's something called the subsidy cliff, and it's returning in 2026. Now here's something critical you need to know about 2026. From 2021 through 2025, there's been what's called enhanced subsidies that made this strategy even easier. You could earn over 400% of the federal poverty level and still get help as long as your premiums exceed 8.5% of your income. But unless Congress acts before the end of this year, those enhanced subsidies disappear on December 31st, 2025. Starting in 2026, we're back to the old rules. If your modified adjusted gross income exceeds 400% of the federal poverty level, that's approximately $85,000 for a married couple. Your subsidies disappear completely. So if Jim and Susan report $84,000 in modified adjusted gross income, they get substantial subsidies. If they reported $86,000, just $2,000 more, they lose everything and pay full price. That $2,000 difference in reported income could cost them $20,000 in premiums. That's not a typo. A small mistake in withdrawal planning can create a massive financial penalty. This is why you need precision. You can't just guess at this. You need to know exactly which account you're pulling from, understand how each withdrawal type affects your modified adjusted gross income, and model this out before you make any moves. Coordinate this with your overall tax strategy. And this is where I see 3 catastrophic mistakes that cost early retirees enormous amounts of money. Mistake number 1, having all your money in pre-tax accounts. If 100% of your retirement savings is in traditional IRAs or 401ks, you have zero flexibility. Every dollar you withdraw counts as modified adjusted gross income. You're stuck. You need diversification across account types. If you don't have Roth or after-tax money right now, you need to start building it through Roth conversions or additional savings. Mistake 2, claiming Social Security too early. Once you claim Social Security, it counts as modified adjusted gross income. If you retire at 59 and immediately claim at 62, you could add $35,000 to your modified adjusted gross income and blow right through the subsidy cliff. I'm not saying delay until 70, I'm saying be strategic about timing Social Security in coordination with your healthcare subsidy window. Mistake number 3, assuming this works the same everywhere. Premiums vary wildly by location. The subsidy formula is consistent, but if you live in an expensive healthcare market, your subsidies will be larger. If you live in a cheap market, they'll be smaller. Your age matters too. A 55-year-old premiums are very different from a 64-year-old's. You cannot copy someone else's plan. You must run your own numbers based on your zip code, your age, your household composition. So here's what this means for you. If you're in your late 50s or early 60s and you've been telling yourself you need to work until 65 for Medicare, you might be wrong. This is exactly how my clients have retired early without healthcare destroying their finances. They thought healthcare was an impossible barrier. Once they understood modified adjusted gross income and how to blend their withdrawals, it became just another line item in their budget. That gave them back freedom of choice. So the real question is, are you going to keep waiting out of fear, or are you going to run your own numbers? You now understand how modified adjusted gross income works. The only question is whether your specific situation allows you to execute this strategy. I want to offer you a free 20-minute consultation with one of our retirement planning experts. Click the link below in the description to schedule your call. We'll walk you through your specific situation and help you determine if you're ready to retire early or what adjustments you need to make. Thanks for watching. I'm Kurt Soupy, and I'll see you in the next video.